So I have a confession to make. I have drunk the Kool-Aid on copper. I think that copper represents the most compelling investment thesis given the structural deficit we face, looming structural deficit starting in 2025. And ironically, we're in a market when everybody acknowledges that we have this supply deficit, we have no new production coming online. Copper is the critical metal. Without copper, none of this battery metal evolution or the move to net zero occurs, yet the copper price isn't responding. And so there's a unique opportunity, I think, at the moment to invest it in companies, not only hot chili, I think we've all had a re-rate down. And so Warren Buffett said it best, when everybody is fearful, you should be greedy, and when everybody is greedy, you should be fearful. I'm the non-executive independent chairman of Hot Chili, so representing the company here today, our esteemed leader, Christian East today is been travelling enormously over recent months and is in Perth, and appreciate the opportunity, and would of course like to thank Jessica and Misha, who are in the audience, for allowing Hot Chili to present. The Precious Metals Summit series of conferences are literally the best in the world, and particularly for those companies of our size. So forward-looking statements, I move past them. If you need some help sleeping at night, I advise you to spend some time reading those. So Hot Chili, we have a very, very sizable copper gold project, the Costa Fuego copper gold project in Chile, in low elevation Chile. And why is low elevation important? It's important because it helps us on the infrastructure side. We have a wealth of existing infrastructure, and it helps on the cost and capex side, which I will touch. We have one of the top 10 undeveloped copper resources in the world that is in the hands of a single asset company like ourselves. The management team has been advancing this project, and we released a PEA in mid-June of this year, and the PEA showed very, very strong economics and a couple of key highlights. Sizable copper production, looking at 112,000 tonnes of copper equivalent production on an annualised basis. A lot of our resource, in fact 97% of the resource is indicated, so very, very high quality confidence resource estimate, and perhaps a touch on that. Our resource team just recently won the Parker Challenge, which is a global competition and recognises expertise in resource. We have independent adjudication that we have a very, very strong resource team. And we're very, very leveraged to copper. As it shows, for every increase, 10-cent increase in the pound of copper, above $3.85, which was the copper price that was used in the PEA, it increases the post-tax NPV by $100 million. So one of the reasons why our PEA had compelling economics and one of the lowest capital capex on a capex in lowest quartile capital cost on a relative basis is our location. It is location, and in fact, I'm an active investor in the sector, and how I look at this sector when I make an investment decision, 3 critical things. People. You need to have a management team and a board that understands what it's doing in a very complex environment and in the volatility that we experience with movement in commodity prices. Project, of course. You can't change the rocks, so you need to have a very, very robust resource estimate. And then place. Place is critically important as you move for the development cycle. So we are in an ideal position in low elevation Chile, less than 50 kilometres from an existing port that we have an MOU with. So that helps on the infrastructure side. Road accessible, we can work all year round. We are very, very well positioned with respect to the build out in solar infrastructure in the country, and have recently established an agreement to have an electrical grid connection to the grid, so we've de-risked it from that element. And perhaps most importantly, we have water. Everywhere in the world, and most particularly in Chile, no water, no project. And so the management team 10 years ago, probably rarely in our sector, in terms of taking a very, very long-term view, realised that water is exogenous risk globally, but particularly in Chile, and that ultimately continental water is unlikely to be permitted, and we're essentially at that stage. So they started the permitting process, which took 8 years, and that's not because we're bad at permitting, that's how long it takes in Chile, and have established a water concession, a maritime licence that is worth material value. And one of the things the reasons why we've been emphasising this more recently, if you don't have water, you don't have a project, but we're trying to get some of the value that water licence represents embedded in our share price. Also, our processing is amenable to seawater, and not only is it amenable, we have a higher recovery to seawater. So back to the capex side of the equation, we do not have to build a desal plant. We're in an industry that recognises growth and rewards growth and drill built success, and so we have a very, very robust development project We understand that you're probably not rewarded in the current copper price environment to be a copper developer right now. And so one of the things that we're focused as a board and a management is ensuring that every dollar that we deploy is aimed at increasing our value per share. And so one of the things that we're very, very good at doing is consolidating property packages, building very, very long-term relationships for very low cost, and then adding a lot of value on the drill bit. And in fact, we announced 2 recent acquisitions today, which have walk-up drill targets. So we're also focused on expanding our existing resource base and the growth side. And as we know in our industry, no matter where you are in the copper cycle, you have great drill results and market rewards you for that. If you're sitting here listening to me today, you probably are a believer in copper like I am. And it really is one of the best supply-demand stories out there. Copper demand, even if there was no move to net zero, and we're already seeing that there are, even if copper demand remains stable where it is today, from 2025, we're starting to see a material decline in primary copper supply. The current copper price obviously is not incentivizing new production. We need to have a price that's materially higher than where it is today for any new production or material investment in expanding existing production to occur. In fact, we're seeing the opposite. We're seeing cost blowouts. We're seeing senior executives lose their jobs because of cost blowouts. And what does that mean? That means that people are even less inclined to put high-risk dollars into new copper production. So that tension, that talk around supply and demand continues to work in the favour of the copper price moving materially upwards in the near term. Companies listed, primary listing in Australia, secondary listing in Canada, and in the OTCQX. We've got a relatively tight share structure, a very strong balance sheet, which is a nice thing to have in this current period of negative sentiment of $21.8 million. Now, most of that capital came in relatively recently with a $15 million investment by Cisco Gold Royalties. Now, as a royalty investment, as a company like us, you either dilute at the equity level or you dilute at the project level. And we have this gold resource that contributes relatively minimal to our NAV, and we thought there was a way to monetize and to fund the business. And so we received US $15 million from Cisco Gold Royalties. So I think a tick of approval. Obviously, any company like Cisco Gold Royalties does significant due diligence on a company like ourselves. They got a 1% royalty on copper, 3% royalty on gold. Probably somewhat uniquely, we negotiated a buyback clause, and that buyback clause is in place for the next 4 years and can occur in a change of control event. So we can buy back 50% of the copper, reducing that royalty, reducing that to 0.5%, and reduce the gold royalty from 3% to 2.5%. And so as we're trying to manage our business, we're trying to ensure that all options remain open and we don't unduly burden the project and make it unattractive to potential acquirers. Our largest shareholder is Glencore at 9%, followed by Blue Spec and insiders own around 1% of the company. Again, we're also investigating the value of this water concession that we have. Is there some way that we can build a water business and create value for our existing shareholders? So showing where we are, the map on the right-hand side just shows the extensive nature of our property portfolio. We have 2 main production hubs. We are very close to the coast. The team, again, took the long-term view about gaining a water concession, so we've resolved that issue. But they've also spent basically a decade acquiring surface rights for all of our planned existing infrastructure. So we have the right-of-way secured for the power line and the electrical line, water line, and we also have service rights secured for most of our planned mining infrastructure. So when we decide to make that development decision, what that means is our development timeline is materially shortened versus a number of our peers. And then finally, on the offtake side, I don't know if people have been watching what's happening in the offtake markets. We have a very, very clean concentrate, very low arsenic, no deleterious elements. That means it's very, very attractive to traders and to smelters from a blending point of view. Most concentrates in the world are increasing arsenic content. Most smelters can take a copper concentrate with a certain arsenic content, so they need to blend. This is a very, very attractive concentrate. Glencore has right to 60% of our concentrate offtake for benchmark prices, and only for the first 8 years of the life of mine. And so we have 40% of our concentrate that remains uncommitted, but we also have another element in that agreement where Glencore must maintain above 7.5% ownership in the company to maintain those concentrate offtake rights. Just touching again on the PEA, robust economics, low first quartile capital intensity, and very, very, very leveraged to the underlying copper price. And in fact, this chart shows that. So if we increase the copper price 50% from our copper price assumption in the study of 385, it nearly triples our post-tax NPV. So just touching on the water side of things again, so this chart shows all of those single asset developers that are in our peer group, and we are one of the only ones with an existing water license. And again, if you want to gain a new water license in Chile, you're looking at around about 8 years to do so. Every company likes to talk about how cheap they are and how undervalued they are, and really our job is to try and make ourselves as overvalued as possible, but therein lies the opportunity today. We have a very robust project, we have a management team, we have local expertise, and we are trading at a fraction of the average in our peer group. And if you want to look at us on a pound in the ground basis, it's around 1 cent per pound. On the growth side, it shows on the right-hand side our extensive property package. We have walk-up drill targets. We have just acquired 2 new projects. We walk up drill targets, and we have begun 30,000 metres of drilling. Just touching on the ESG side of things, we always have to, although Larry Fink has said we're no longer allowed to use the term ESG because it's weaponised. But again, due to the location, we have a low carbon footprint because we're leveraging off existing infrastructure. Like every company, it behooves us to be a good corporate and social citizen. If you are not, you will cease to exist as an entity. And on the governance side, of course, we are very focused on that. And one thing I should highlight is any company that is working in another country, gringos are very, very guilty of not leveraging off local expertise. And so we have Chilean nationals on our board, and every single person that's working for us in Chile is a Chilean national. So deep value, we're a deep value story, but how do we extract that value? Number one, exposure to the underlying copper price. Copper moves, we should move with it. We have a track record of creating enormous value by consolidating assets and generating growth, and we have another drill program underway. We have the right expertise to take this project forward. And timing is everything. We live in uncertain times, and so having discipline about how you allocate your capital is key. We do not want to dilute our existing shareholders to near nothing. And thank you very much. I think we have some time for a few questions.
We do. Do we have a question from the audience? I have one for you, Nicole, if we don't have one from the audience. You recently acquired the Cometa project, which is near Costa Fuego. Can you talk about how Cometa fits into the overall strategy going forward?
Yeah, so this company has built itself from consolidation, and we have a production hub, and so we think that this is a very underexplored district. We're very excited about the potential, and it's not just Cometa, we've just acquired 2 more, and the approach here is to go for assets where there's evidence of copper mineralization. So whether it's some historic limited mining, and these things tend to be deeper, and that's exactly what Cortadera is. That's become the bulk of our resource. It had a shallow expression, it had been patchily mined historically, and we created a very, very large resource by taking smart exploration, modern exploration techniques, and advancing those projects. And so what we're trying to do when we acquire something, there's always a low upfront cost, and really drill it or kill it. So do what we should do, which is grow the business in a systematic and as a lower cost way as possible.
Excellent. Okay, we'll leave it there. We're out of time. Thank you very much.
Great, thank you.
Thank you.